Welcome back. We're talking with Bond King Jeffrey Gundlach. Jeffrey, do you think there's a recession on the horizon over the next 12 months?
I don't think that the indicators that we like to focus on are signaling a recession, but we're watching them carefully. There's basically 2 or 3 indicators that investors should look at that are almost fail-safe in indicating recession's coming. One is the leading economic indicators, which year over year going below 0 tends to be highly coincident with recession. Right now it's not strong, but it's not close to 0. So that's encouraging regarding no recession. But one thing that we've really started focusing on is the unemployment rate. If you take the unemployment rate that's reported every month and you compare it to its 12-month moving average, you never get a recession, ever, without the unemployment rate being above its 12-month moving average. The good news is it's below its 12-month moving average. Now, there's false signals in that indicator. It does sometimes cross above its 12-month moving average and falsely signals recession, but you never get a recession without it crossing over. So the good news is it's below its 12-month moving average. The bad news is it's probably going to cross over around August or September of this year because the unemployment rate has stopped falling.
So if we were talking in August, you'd say high likelihood for the 12 months forward that there could be a recession on the horizon.
I don't know if I'd go high likelihood because there's one final indicator that's really important, which never gives a false signal. And that's the quarterly unemployment data compared to its 3-year moving average. And that crossing over almost guarantees a recession. It's eerie, actually, how accurate it is, the crossover point being the front end of a recession. That's not going to cross over for a year or maybe even 2 because the unemployment rate fell so much. Now, these indicators may not work all the time, but they give us confidence that 2016 will not print probably a negative.
And I think it's also important to remind viewers that part of what happened in earlier this year was the concern about the recession was also weighing heavily on equities in the early part of January and February.
Yeah, it's kind of hard to tell what cause and effect is. I mean, on February 11th, with the equity market tanking, you start to wonder, gee, is this a recessionary signal? One of the components of these leading indicators that I talk about is the performance of the S&P 500, the stock market. And when it's down heavily, which it was from the middle of December into February 11th, then you have to start worrying about recession. But the rebound has been, taken some of that pressure away.
Jeffrey, I want to talk about asset classes. Anthony read in the intro, the Bond King, the media calls you the Bond King. They have now for several years. I think you're the best, as you know, I think you are the greatest investor out there in terms of all asset classes.
You're too kind.
But you know it's the truth.
He's the king of Long Island, by the way. I just happen to be one of the princes out there.
We did something famously many years, and we've done it, where I asked you about various asset classes and your outlook for the overall asset class.
Yeah.
I think viewers have found that very helpful. A year ago, you came on Wall Street Week and you gave what was the initial warning on the high-yield market, which was a very important warning.
Yeah, and it dropped like 20–25% in price over the next 9 months.
Yeah, and that was on this program the first time anybody warned. So let's talk about various expected returns if one was to invest new capital today.
All right.
The equity market in the United States, what would you say the expected return would be?
Over what horizon are we talking about?
Let's say the next 3 years.
Next 3 years, I think you're talking low single digits.
And the high-yield market?
Over 3 years, I think the high-yield market will probably do about maybe 4 or 5%.
And if I was to be in an unconstrained, go-anywhere bond fund that can go anywhere in this environment, how would those returns compare to a equity return or a high-yield return?
I think probably slightly higher, but it's going to be highly dependent upon the strategy that's being used. The unconstrained bond fund thing, I think, was sort of a fad that was brought on by the taper tantrum back in 2013, when suddenly there were big negative returns over a 2 or 3 month period in bonds. People said, oh, I'm very worried about rising interest rates. And it's turned out that unconstrained bond funds as a category have been really disappointing. A lot of them have been negative because they owned junk bonds a year ago, and some of them, unfortunately, not only buy junk bonds, but they try to get rid of the interest rate risk by then shorting treasuries. That's a uniquely bad idea, buying risk and shorting safety. I mean, try selling that to your grandmother.
Right.
Hey, this is a great idea. Buy something risky and then hedge it by shorting safety. But some unconstrained bond funds that are more sensibly managed don't short the safety. They take various sleeves of credit risk. I think those can do something like 6 or 7% if they're managed correctly, so particularly if interest rates rise, which I am fading the interest rate rise concept from the Fed a lot. I've been doing it for years. years. But I do think the Fed wants to raise interest rates. And generally, things that people think that when interest rates rise, bonds don't do well. But if you're owning shorter-term bonds, which I think is appropriate now for unconstrained bond funds, rising interest rates are your friend. You're rolling over short maturities at higher and higher interest rates.
Right.
But these returns are real returns. So a 6-7% real return, Jeff, is a good return.
Yes. Well, we're in a world where there's very little inflation. I mean, there's finally some wage growth for lower wage workers, finally, with minimum wage increases and the like. But broadly speaking, there's very little inflation. You look at commodity prices, you look at the CPI. People laugh at the CPI. I don't know why. CPI is the granddaddy of inflation because they like to strip things out, take out energy, take this out.
Well, talk about energy for a second. What's your view there now, and do you think that energy market is still distressed? Because one of the things you said a year ago was that the energy component of the high-yield ETF was going to falter, which would lead to that swoon.
Right. A year ago, the energy picture was incredibly depressing because the supply was enormous and the demand was well below the supply, and it takes time to work this through. The good news is it's a year later, and so time is passing, and so the demand and supply imbalance is not as bad because the rig count is down and the like. I turned bullish on oil actually in January. I did a webcast January 12th, and I actually said oil's going to bottom, I think, tomorrow. Turned out I was wrong. It bottomed a week later. But it was down at $28 a barrel then, and I said it's going to have an easy time going to 40. I don't think we're going to see oil in the 20s again. So yet oil isn't high enough, anywhere close to high enough, to forestall defaults in the energy patch, the high-yield market. So we're looking at a default cycle that's already apparent. I mean, you're getting filings pretty much every day in the energy patch, and that's going to continue. I have a hard time believing that high-yield bonds are really going to rally sharply further, given that the default cycle is in front of us.
Yep. Great insight. We'll be right back with more.